Hey, it's John Crypto. Get ready, because what just happened on the market isn't a dip. It's a full-blown financial massacre. In the last 24 hours, $756 million in crypto liquidations have happened on BTC and ETH. Longs were wiped out. $147 million in BTC and $171 million in ETH disappeared like smoke. ETH dropped almost 10% to 2,228, and BTC fell below $77,000, losing an incredible $800 billion in market capitalization since its peak of $126,000 in October. And here's the kicker. All of this happened when there wasn't much liquidity between Asia and the US. This was a perfect storm that left retail traders hanging by a thread. The news wants you to think that it's just volatility or that markets are stabilizing. Nice story. Headlines are telling a story that everything is fine, but they are hiding the harsh truth. Asia-US flow imbalances, strategic ETF rotations, and big players quietly building up their positions in the OTC market. They make it look like everything is fine on the surface, but underneath, the ocean of forced liquidations is tearing accounts apart. The truth is that more than 200,000 accounts were margin called during the chaos. Retail traders who were too confident and too much in debt were the first to go. While small holders screamed and sold into the void, mega whales like BlackRock, JP Morgan, and shady Asian OTC buyers were quietly cleaning up the mess. There are now 120,000 ETH in cold wallets, which means they are no longer available for trade. Retail traders lost 150,000 ETH in a panic. You can almost hear the coins going from retail stores to whale vaults. Now put the pieces together on volume. In the hours leading up to the liquidation cascade, open interest shot up, showing where smart money had already placed its bets. The imbalance was huge. Longs were crushed, shorts were mostly fine, and ETH took 44% of the damage. The daily trading volume fell from $47 billion to $40 billion, taking away the liquidity cushion and putting retail at risk of brutal margin calls. Every little drop caused huge sell-offs. The market was a trap that had been perfectly set up. The big difference between retail and smart money is that retail accounts were margin called at $2,400 ETH and 77K BTC, which wiped out their positions. People were selling in a panic, which made things worse, but the whales moved like shadows, quietly buying up what everyone else wanted to get rid of. Panic buying like Michael Saylor? Check. Strategic accumulation by smart wallets? Check again. Positions that disappeared from exchanges last year are back, quietly strengthening floors without making any news. And it gets worse. The stories that the media tells you aren't just wrong, they're also part of the system that keeps you stuck. They talk about stability, but the real story is in the order books. Retail is being crushed, derivatives are being used to their fullest potential, and institutional players are calmly stacking coins like predators, circling a herd that has been hurt. ETF inflows, stealth buys on the over-the-counter market, and cold wallet accumulation are changing who really runs the market. You thought you saw volatility before? Forget it. This is a liquidity flush caused by thin markets, leverage imbalances, and geopolitical shocks that retail investors can't even understand. Not only were BTC and ETH sold, but they were also used as weapons in a market-wide squeeze that left thousands of people in debt. And the worst part? This is only the start. You think this $756 million crash is just a mistake in the price? The exchanges are losing money, and the real blood is in the order books. Wait until part 2. Retail sees chaos, whales see opportunity, and the market's bones are out in the open for anyone who wants to see them. The next chapter shows exactly how the supply chain of crypto is being drained, and why what comes next could make this wipeout look like a warm-up. As retail traders rushed to hit the sell button, exchanges were losing money. In just 1 week, the balances of BTC and ETH on major exchanges fell to their lowest levels in months. 50,000 BTC and 200,000 ETH disappeared from active trading wallets. The best part is that the disappearance isn't random. Most of the ETH accumulation zones are in Asia, where cold wallets quietly suck up supply while retail liquidity disappears. Thin order books turned every small dip into a massacre of margin calls, making the chaos worse. Now put the pieces together on leverage. Paper derivatives are taking over, while the real liquid supply is getting smaller by the hour. The margin call cascade tore through the overlap between trading in Asia and the US, causing more than $2.5 billion in liquidations in just 24 hours. Retail accounts were stuck, leverage was at its highest, and panic selling sent coins straight to the vaults of institutions that were ready to buy them for a fraction of their previous price. Every forced liquidation was like a conveyor belt that brought whales cheap BTC and ETH. Here's what the bad guy does. BlackRock and JP Morgan weren't reacting. They were ready for it. ETF inflows showed tactical accumulation, even though the retail crowd was still shaken. Asian OTC trades quietly took supply away from public exchanges, where regular traders couldn't see them. Retailers weren't just losing money, they were also supporting a system that had already decided the outcome. The bait and switch worked perfectly. Geopolitical shocks and hawkish comments from the Fed made people panic in the stores. Investors sold $2.2 billion in ETH because they were scared and didn't know that institutions were calmly buying up every coin that came on the market. The whales had a great time with panic selling. The price wasn't free, it was planned. And the more the news said that markets are stabilizing, the more retail stores went out of business. This has happened before. The echoes of history are deafening. FTX collapse, 2020, DeFi liquidation cascades, and 2008 systemic leverage squeezes all followed the same brutal pattern. Panic triggers, forced liquidation, smart money absorbs supply, and slow stabilization leaves retail gasping. History is repeating itself, but this time it's happening faster and more violently, with smart global capital taking advantage of every weak hand. Volume also tells the story. The market's liquidity thinned, price drops caused big sell-offs, and whales moved without making waves. While retail continued to lose money, large wallets quietly consolidated their positions. Every flash crash is a warning sign. The real power in the market isn't with regular traders, it's in cold storage, shady over-the-counter deals, and ETF flows that the public can't see. And here's the scary part. This is just the beginning. While the West freaks out, Asia quietly takes in every forced liquidation, making its position stronger and its control stronger. It's not just that BTC and ETH are bouncing back from a short-term dip. They're being strategically hoarded to prepare for the next global shakeout. But that's not all. The East is quietly buying up BTC and ETH, while retail watches charts with shaking hands. Part 3 shows the geopolitical tug-of-war behind these moves, showing how Asia is quietly taking advantage of US weakness to gain an edge in accumulation, and what that means for the global crypto battlefield. The next chapter will shock you. The East was quietly planning a takeover while retail investors rushed to sell their stocks. After the US liquidation panic, ETF inflows into Hong Kong and other Asian exchanges shot up. This showed that there was a coordinated accumulation that no one outside of these corridors could see. On-chain whale transfers sent huge amounts of BTC and ETH into cold wallets all over Asia. This was the best example of stealth positioning. The best part is that Asia's daily centralized exchange volume is now around $3 trillion, which is a lot more than the $120 billion in US ETF liquidity. This imbalance makes every dollar and token move bigger, which is a perfect storm for institutional dominance. Now put the pieces together on the secret buyers. Central banks and secret wallets are quietly taking in coins that have been sold off without using public exchanges. OTC deals in Asia take supply away from the visible market, leaving retail in the dark and vulnerable. Headlines in the West are obsessed with price changes, but huge amounts of BTC and ETH disappear into private holdings, changing the supply map without anyone noticing. Policy changes are very important. The US government's lack of clear rules and increased scrutiny of ETFs have made the market more volatile, which has made retail investors hesitant and scared. At the same time, Asia is quietly opening stealth corridors. Looser rules on cryptocurrencies and fewer restrictions make it easier for whales and institutional players to operate without fear of getting caught. The difference couldn't be clearer. The West freaks out while the East steadily stores. The war in the supply chain is getting worse. The difficulty of mining BTC keeps going up, which makes it harder to get new coins into circulation. When you stake ETH, you take away the liquid supply and lock it away from retail investors. Every forced liquidation from the US panic doesn't just go away. It gets turned into a weapon that helps Asia's strategic accumulation. The market is like a chessboard, and retail traders are being taken out of the game before they even know it. Replacement threats are no longer just ideas. Bitcoin and Ethereum, two types of cryptocurrency, are becoming more and more popular for cross-border payments, which is a threat to the US dollar. As demand from central banks in Asia and the Middle East rises, these assets go from being speculative to being important players in the system. Every move in Asia now has an effect on the whole economy, and the $756 million liquidation is just the first sign of a big change. Here's the cruel truth. Retail traders believe that volatility is random. They freak out, sell their coins, and give the East the tools it needs to take over the market. Institutional players work on time frames of months and years, building up their positions while chaos reigns above. Asia isn't reacting. It's following a carefully thought-out plan to take control of the world's most liquid cryptocurrencies. And here's what's going to happen next. The global market isn't just experiencing a drop in prices or a short-term lack of cash. The effects of this $756 million liquidation are long-lasting. It will be too late to stop the trend when retail finally realizes they've been feeding institutional accumulation. Asia's dominance in accumulation, along with the US's shrinking supply and strict regulations, sets the stage for a showdown that could change crypto's place in the global financial system. All of this points to one thing. The global economy is about to feel the effects of this $756 million liquidation. Part 4 will show the big picture doom, the debt and Fed traps, and why retail traders are going straight into a system that is rigged against them. The countdown to the next planned crash has already begun. As the smoke clears from the $756 million liquidation, the problems in the world's financial system are becoming clearer. The US national debt has grown to about $38 trillion, Japan's bond yields are rising, and the whole leverage system is on the verge of collapse. Crypto wasn't just collateral damage, it was the canary in the coal mine, showing how weak a world built on borrowed money and risky bets can be. The Fed is stuck, and here's the kicker. Inflation won't go down, and every effort to stabilize the markets like repo operations or liquidity injections only helps for a short time. What is the long-term risk? Systemic blowouts that are much worse than anything retail has ever seen. Every $478 million BTC liquidation and $520 million ETH wipeout isn't just a number on a screen. It's a sign that the system is rigged against small holders. Retail is always the first to lose money. Exchanges are empty, derivatives are too high, and retail is still stuck in the middle. Smart money like whales, institutional funds, and shady OTC buyers are quietly getting ready for the next engineered squeeze. They know that when retail builds up leverage again, there will be chaos. The markets have turned into a high-stakes game where every panic and margin call is planned ahead of time to make money for institutions. There are clear price signals. BTC is likely to test the 65K support level again, while ETH is staying close to $1,750. These numbers aren't just numbers, they're institutional floors that will soak up panic selling and trap retail again. Whales are ready and waiting just below support lines, ready to cause the next liquidity flush if small holders go too far. Now is the time to act. Get out of banks and take care of your own money. Every centralized ledger and every leveraged exchange is a trap that will catch the next panic. Retail can't count on headlines about market resilience or short-term rallies. You are in charge of your own keys, your own assets, and your own future. And while you get ready, hit subscribe and like to stay ahead of the next planned crash. The next wave won't give you a second chance. It's not free to look at prices on a screen. It's about keeping control where it counts. In cold wallets, in self-custody, and in choices that aren't affected by the systemic traps set up by banks, the Fed, and whales. Every $756 million liquidation and every leveraged wipeout is a lesson. Power is at the top, and retail must act or be erased. The world economy is in a very dangerous place. Retail panic helps institutions make money, printing money fills in temporary gaps, and Asia quietly builds up its power behind the scenes. Not every price change is random. It's a planned move in a game where the house always wins. Freedom isn't in seeing prices on your screen. It's in having control over your own keys, assets, and future. The message is clear. The $756 million in liquidations is a preview of what will happen. Markets will keep hurting retail first, rewarding those who are ready and punishing those who aren't. Staying subscribed, liking, and paying attention isn't just engagement. It's how to stay alive in a system that favors the top. Don't let the system trap you anymore. Leave the banks, keep your crypto safe in your own hands, and protect your money from the next planned crash. Hit the subscribe button and the like button right now to stay one step ahead of the whales and never miss the next $756 million wipeout.